Hello and welcome to Portfolio Matters. In today's podcast, Stuart Owen will be talking about why investing in growth stocks is generally a bad idea. And as we are not discussing any individual securities, I won't do a full disclaimer, but as always, do your own research. A full disclaimer can be found at the end. Take it away, Stuart.
Thank you, Keith. So as Keith said, today we're going to talk about growth stocks and growth investing. And this is in the context really of what's happening to the NASDAQ and some interest that people have shown in possibly buying into the NASDAQ after the falls that we've seen in ETFs, for instance, like ARK Invest. And the other thing to say by way of preface is this presentation is based on some research done by Verdad Investment Management by Dan Rasmussen, and we found it very interesting and very timely, and this is a summary of their research. So growth investing and value investing are two very typical ways of determining an investment philosophy. So growth investing is the idea that you want to bias your portfolio towards companies that are growing better than average. And of course, those companies will typically have a higher valuation than value companies, whether you measure that by price to earnings, price to dividend, price to EBITDA, price to eyeballs, whatever the measurement is, you'll pay more for a growing company than for a moderate growing or shrinking company. And the market believes that growth will continue and awards companies with high revenue and earnings growth much higher valuations on things like PE or enterprise value to EBITDA, etc. But one thing that we should all be aware of is that the valuations of high growing companies are very sensitive to growth and discount rates. And that is a big issue currently. We're all somewhat worried about the growth outlook, and we should be very worried about the discount rate outlook, given what's happening in fixed income markets. So the question really that Verdad were looking at was, is it true that it's worth paying up for companies that grow a lot? And that's what their presentation digs down into. Now, there are quite a few tables like this, so it's worth spending a little bit of time pausing and having a look. And I'll run through this one in a bit of detail, as it's a good example of the other tables that Verdad have produced. So what they're doing here is looking at the proportion of companies that had above median growth and seeing whether they persist into subsequent years. So obviously in the first year, there's going to be half the companies have got better than average and half the companies have got lower than average growth on measures such as revenue, EBITDA, EBIT, or EBT, so earnings before interest, tax, depreciation, and amortization, etc. So in the first year, of course, half will be in the growing group, half will be in the relatively shrinking group. And what you're hoping to see, if you believe that growth persists, is that more of those companies persist into years 2, 3, 4, and 5 than would purely by chance. However, what Verdad's research shows is that, of course, 50% were above average in year 1, but only 25.5% continued to be above average in year 1 and year 2, for instance, on revenue growth. Now, you would perfectly expect purely by chance that 25% of companies had higher growth in year 1 and year 2, purely by chance. And then similarly, you would expect 12.5% in year 3, 6.25% in year 4, 3.125% in year 5. So that is the purely sort of naive assumption.
So, Stuart, can I just quickly come in to clarify? So what you're saying is in year 1, 50% of companies will by definition be above median. And in year 2, those 50% in the top half, you'd expect 50% of those, i.e. 25%, to remain in the top median. And so you're always looking at the performance of that top half in the year one and how it persists in subsequent years.
That's exactly it. Well explained, Keith. Absolutely. So as Keith said, you'd expect 50% in year one to be above median, 25 in year two, 12.5 in year three, etc. But if we look at the percentage of companies that actually show that pattern of being above median in year 1, 2, 3, 4, 5, etc., the difference from chance is very small. So for instance, in year two, only 25.5% of companies that showed above median revenue growth continue to show that in year two. And you'd expect by chance for it to be just 25%. So only 0.5% more companies than you would expect purely by chance. Now, if you look at this table in more detail, looking over perhaps to year five, there were slightly more companies showing 5 years consistent above median revenue growth, 5.9% against the chance of 3.15%. But that's not that much more. So there seems to be very little persistence in growth if you try to divide the market up into high and low growth purely based on historic revenue growth, for instance. Now, if you look at that same measurement further down the profit and loss statement, so at EBITDA, EBIT, and EBT, which you could think of as actually being more relevant to shareholders, that's what we end up with. Again, you see an even stronger pattern, which the pattern looks much more like chance. There's very little persistence in, for instance, EBITDA, where the proportion of companies that show consistent EBITDA growth is very little different to chance. Well, one objection could be, well, hold on, what about the very high growing companies, the cream of the crop? So if we Verdad have cut the cake in a different way now, looking just at those companies that show that are in the top 25% of revenue growers. Now here the picture is a little bit more encouraging. If we look at the revenue line here, the proportion of companies that continue to show above median revenue growth in year two is not the 25% that you might get by chance, it's 31%. So it is 6% better than chance. However, the same somewhat depressing pattern that we saw on the previous slide is also evident here with EBITDA, EBIT, and EBT, where there's basically no difference in the persistence of growth for the very best companies than you would expect purely by chance. So to me, this suggested that perhaps there are growing industries, and hence the revenue growth line, you do get some persistence in growth, but not in terms of profitability. So perhaps there are growing industries, but those industries suck in more competition, and there's more margin competition, and hence the profitability of these high-growing companies is actually no different to the overall market. Another possible objection to this sort of conclusion is to say, well, hold on, to expect a company to be above median in year 1, 2, 3, 4, and 5, it is rather a high hurdle. What about a company that is growing strategically, but perhaps suffers 1 or 2 years of weaker performance amongst a long-term rising trend? So here, what Verdad have looked at is the cumulative performance by year, up to year 5. And here, unfortunately, we don't see too much of a pattern in the high growth companies. So those companies that show the highest trailing EBITDA growth do not persist. And in fact, if anything, there's evidence of more mean reversion there, where optimistic projections of EBITDA growth simply do not play out. And the top growing companies actually produce less EBITDA growth in the future than you would expect purely by chance. That was at the top. If you look at the lowest EBITDA growth companies, there is some evidence that the losers keep losing. And interestingly, it seems to be more that the middle and reasonable growing companies do show some more than you would expect persistent in EBITDA growth. Now, that was an analysis based on segmenting the market and segmenting and identifying companies' growth potential purely by looking at their historic performance and ranking them. But you might object, well, hold on, it is possible to have a view forward. We do have, for instance, stockbrokers, analysts whose whole job is to look at individual companies and to forecast their growth prospects forward, including their opinions about the industry growth, the management quality, new products, etc. So isn't it a little bit naive purely to look at historic growth in revenue, EBITDA, etc.? However, Verdad's research has also looked at the performance of companies when looking at the earnings and revenue forecasts from the stockbrokers, analysts, trying to assess and synthesize all the information about a company. And here, for instance, if we look at their median 3-year forecast for revenue, they would forecast typically 7% growth in revenue, but the actual growth turns out to have been only 5.7%. So a cumulative error of 4.6% in revenue, for instance. Now, the picture gets even more depressing when you look further down the P&L statement again, where their forecast for EBITDA growth of 11% are severely underperformed by the reality of 5.7%. So that gap of a bit under 6% a year accumulates up over 3 years, meaning that their EBITDA forecasts are 19% too optimistic, and their EBIT estimates 29% too optimistic, and their EBT estimates 37% too optimistic. So it seems that, in essence, the stockbrokers, analysts are drinking the Kool-Aid. They are believing the growth forecasts and the historic growth, and they are over-projecting growth into the future. Now, it might have struck you that numbers like 6 or 7% growth seem like a familiar type of number. And it's a familiar number because it's roughly what nominal GDP does. So if, for instance, you swapped out your individual company revenue, EBITDA, EBIT, EBT forecasts, and simply assumed GDP growth, nominal GDP growth, you get a much, much smaller error. So again, this really suggests that there's a sort of mean reversion going on, that growth companies, despite the wonderful stories that their industries tell, are really sort of cannot resist the gravitational pull of competition, and that their financial performance is pulled back towards GDP growth. Now, this is not to be completely dismissive of analysts and their forecasts. Analysts do have some ability to sort companies into different quintiles of growth. So Verdad's analysis here is trying to look at, if you rank companies and put them into top 20%, next 20%, down to the lowest 20% by certain characteristics such as revenue or EBITDA growth, and then you compare which cluster, which group, which quintile they're in initially, and in terms of the outcome, analysts do seem to have some skill at allocating companies into different growth buckets. They do find the companies which are going to grow their revenue or EBITDA faster than other companies. The trouble is, though, that for a stock to outperform, it mustn't just grow, it must beat the embedded growth forecasts that were already in the share price. And that's where we're fighting again the mean reversion. Now, it's a rather busy table here, but the key point is always that the error in the forecast from stockbrokers, analysts is higher for the high growth companies. So if we look in the top panel here of estimated and actual revenue growth, the top revenue growers do grow more than the bottom revenue growers, but the estimate is too optimistic. So for instance, the analysts estimate 19.4% revenue growth, but the actual turns out to be 15% a year, and that gap accumulates up to an error in revenue forecasts of 16% for the high growth companies. The error for low growth companies is still biased towards over expecting revenue growth, but it accumulates up to just 4% as opposed to a 16% error for revenue. And as Verdad have found in all their analysis, the further you go down the P&L, the bigger the error becomes. So EBITDA estimates for low growth companies, analysts are over optimistic by 8% over 3 years for the low growth companies. But for the high growth companies, the error accumulates up to a 68% cumulative error in EBITDA forecasts. So although analysts are able to identify which companies are growing faster than others, if the market is at all betting on and including those revenue and EBITDA forecasts in the stock price, then the hopes are far too high. And as I was saying before, a stock has to not just meet, but beat the underlying growth expectations if it's going to outperform. And the hurdle being set in these over-optimistic forecasts is just too high. So putting that into context of what's happening in the market, well, I think in effect, we're seeing companies being mugged by reality. We show here the performance in orange of the ARK Tech ETF and the performance in blue of the NASDAQ. And basically all the optimistic growth expectations are being torpedoed. The hopes for these companies are being pulled back to earth, and they're disappointing. And of course, if you're a company, for instance, valued on 50 times revenue, and you don't meet your growth expectations, the room for you to fall is precipitous. And that, in effect, is what we're seeing at the moment. Looking at that in a bit more detail, Keith has a chart here from the weekly, which looks at NASDAQ earnings forecasts compared to S&P 500 earnings forecasts. Now, you would normally expect this line to be upward sloping. You would expect the fast-growing companies in NASDAQ to be beating the more general market as synthesized into the S&P 500. But since about this time last year, that mean reversion, that pulling in of expectations, the mugging by reality has begun to happen, and NASDAQ's earnings have been falling relative to S&P 500 earnings. So in summary, the market and analysts tend to overestimate the persistence of revenue and earnings growth. So be very careful about buying companies on high valuations with high embedded future growth expectations supporting the share price. There's a strong risk of being mugged by reality and experiencing earnings and share price disappointment.
Thank you, Stuart. Would you mind actually backing up, was it 4 slides to the last table? I mean, I thought this was absolutely fantastic. You know, this is all you really need to know. Particularly as you descend this chart, this table, the earnings miss, the over expectations gets worse. And I notice that there are no rows which are just earnings after tax, which is what shareholders really care about, and where presumably the miss would be even worse, because as you descend this table, the misses get progressively worse and worse. And it's interesting that all companies, the analysts overestimate the earnings. It's not just for high growth ones, but even for low growth ones. Analysts just in totem are over optimistic, but they're really, really over optimistic for high growth companies. Or should I say, companies with historic high revenue growth or earnings growth. So
yes, it's absolutely flabbergasting, isn't it? And I think we see this in the bottom-up earnings expectations for a stock market, which are almost always higher than the top-down expectations. Someone looking top-down will, in a sense, have some limiter on what they think earnings growth or revenue growth can ever be, because they have in the back of their mind, what GDP is likely to do. Whereas if you're a bottom-up micro analyst, you can drink the Kool-Aid.
yeah. Great. Okay. Thanks, Stuart.
Well, thank you for that research. I think they're the people who've done the hard work on this, but it's a fascinating study and it's available on their website.
Great. Okay. So I hope you all enjoyed that. Please, can you press like and subscribe to the channel? And in the meantime, it's goodbye from Stuart Owen.
And it's goodbye from Keith Jordan.
Goodbye.
Goodbye.
Full disclaimer. The material and information contained in this podcast is for information and entertainment purposes only and should not be relied upon for making a business, legal or any other decision. We may own or have a financial interest in any securities mentioned. Listeners should conduct their own research or consult a professional investment advisor before making any decisions regarding topics mentioned on the show. Whilst we endeavour to ensure that the information presented on the show is correct, we make no representations or warranties of any kind, express or implied, with respect to the podcast and website or to any information, products, services or related graphics discussed or presented in the podcast or website. Any reliance you place on such material is strictly at your own risk. You are solely responsible for the investment decisions you make. We will not be responsible for any errors or omissions in the podcast or website, including in articles or postings, for hyperlinks embedded in messages, or for any results obtained from the use of such information, nor will we be liable for any loss or damage, including consequential damages, if any, caused by a reader's reliance on any information provided by the podcast or website. Please do not listen to the podcast if you do not accept self-responsibility for your actions.